Barry Bannister. He is Stifel's head of institutional equity strategy. He's joining us from Baltimore, Maryland. It's good to have you here. There's a lot we want to talk to you, especially about the warning signs you have in comparison to, you sent us a note where you talked about the Nifty 50 of 1972 and the lessons to be learned. But I got to ask you right off the top, what is going on here?
Well, to us, it felt like after the early August, we wrote a note saying we thought there'd be a 5 or 10% pullback. We had a very strong July and August. It felt like the summer of love, 1969, in the stock market. Everyone was just piling in, and it looked overvalued to us. So we're taking off some of the froth right here.
Barry, Dan Roberts here. If we look at the tech names and how they behaved in the last 2 days, a lot of the names that have pulled back the most are just the ones that really flew too far. They got so high. I mean, we had discussed a couple analyst notes last week on Tesla, for example, that just basically readjusted their price target only on the basis that it had become overvalued. Still very strong bullish on Tesla's near future. Same for a lot of these pandemic names, Peloton, Slack, CrowdStrike, a lot of these names that really have been hit the hardest since yesterday. And I just wonder, even if this lasts a few more days or however long this reset lasts, there's no new reason, as far as I can tell, to be more bearish on these tech names. All these names that have pulled back, the prospects are just as good for them, into the continuing pandemic and even beyond, right? Do you expect these tech names to still be the highest flyers once this kind of reset finishes?
Well, the reason we did our note today regarding the one decision stocks, the buy them and forget them, they're just great in companies and they will grow. That was the mentality in 1972 with what was called the Nifty 50, as it was promoted by Morgan Guarantee and Kidder Peabody. What happened was over the subsequent 10 years, 72 to 82, PE compression fell by over 60% in those names on a median basis. Even though their earnings outstripped the S&P, their price to earnings ratio fell at 40 times. They were just too expensive. Well, today we have the same thing with great companies at too great a price. So what's happening is some of the froth, the Fed is committed to reflation. It looks like we have populism, which means more fiscal spending. The fiscal debt will be stored on the Fed's balance sheet. Don't fight the Fed is a pretty good rule to live by. It may take them some time, but this Fed is committed to reflating, and that's not good for long duration equity, which has a high price to earnings multiple if we do ever see inflation within the horizon of, let's say, the next 5 to 10 years on a significant level. Any change off a low base is a large change, and that's just not good for growth. That's what happened in the 70s. That's what happened to a limited extent with some of the tech names after the 2000 tech bubble. So that was the purpose of our note today.
Barry, just to add to Dan's point here, when you look at the pullback we saw yesterday in the tech names, do you see that as a healthy correction? And if so, when you look at the names that Dan mentioned, like Apple, like a Tesla or a Slack, is there additional pullback that's needed to really bring it down to where the value is?
Well, if you just take, for example, the NASDAQ 100 index, which I use to symbolize tech, we're already back to where we were on August the 19th. If I can still remember what I had for lunch on August 19th, it wasn't that long ago. So, no, I don't view it as anything more than just a healthy correction, but there have been some macro shifts. I think the policy aspect, we've got arguments over more fiscal. We have the Fed somewhat limited in their options at this point. People realize that there was some froth in the market, the silliness of getting excited over splits when you can buy fractionals on most platforms. We saw some craziness in the market. And if you study market history and bubbles, you know that craziness and cults of personality, repeat themselves. Ivan Kruger, Elon Musk, people get excited about a person, people get excited about a few names. It's normal. It's just business.
Some of the names from the 1972 Nifty 50, they were excited about: Philip Morris, Texas Instruments, General Electric. Help us understand, though, and it's repeating some of what you've already said, but where we stand right now, cyclically adjusted price to earnings multiple of the S&P 500 knocking on the doorstep at the same point it did when the markets broke out, say, in the 1920s or 1990s. What does that mean today for us? It sounds to me as if what you're saying is today is not the day to get out. It might be the time short term to get in.
Well, that is another point that was in our note. It was a two-section note. The other point was we took a look at what's called the Shiller CAPE, Bob Shiller at Yale. It's the PE on trailing 10-year inflation-adjusted average earnings. So you take the earnings the past 10 years, adjust it for inflation, so it's all on the same basis, and then take an average. So you're just doing a cyclically smoothed price-to-earnings ratio, PE on 10-year earnings. And what we find is when you do that over a very long period, we did it monthly using S&P data and Shiller data since 1920. When you do it over a long period, it tilts upwards, and you'd expect that, higher return on capital, lower cost of capital, exorbitant privilege, the U.S.'s dominant position in the world, technology, et cetera. But what we found was that within that uptrend, at this point, in other words, to be precise, 1.31 standard deviations above trend. At this point, we have only broken out twice. And that was the last 2 years of the 1920s bull market and the last few years of the 1999 or 1990s bull market. Okay, so the roaring 20s and the 90s bubble, that's your precedent. To go higher, you have to duplicate that. I mean, good luck. I mean, that's 100 years of data, and you have to find 5 years like that just to go higher. So for me, it's picking up dollars in front of a steamroller until we get some confirmation on a bubble. If we get a bubble, it's going to be a greater fool theory. Can I find somebody to pay even more than I did for this thing? And then can I find the top? Everyone thinks they can. Very few people do.